Hey everyone, welcome to video number 3 of the Tax Efficient Charitable Giving video series. In this video, we're going to pick up where we left off in video 2 by talking about donor advised funds. Now, if you recall from our discussion on charitable bunching in video 2, there was a practical issue with the bunching strategy, which has led to the popularity of using donor advised funds, also known as DAFs or giving accounts. And the practical issue was that folks often like to do charitable giving on a regular and recurring basis, which makes the bunching strategy challenging to implement. So a donor advised fund is basically this. Here's you make a contribution over here to a donor advised fund. And then from the donor advised fund, you can basically distribute according to some sort of giving plan, or basically dole out, as I call it, the money that you have contributed first to the donor advised fund. You dole that out to the ultimate recipient charities based on whatever giving schedule you decide. Now, if we focus on this first part of the transaction right here, this part of the transaction allows you to basically super bunch a large amount of your giving into the same tax year. And we're going to go into the personal tax planning template in a little bit to see how that works. But just to be clear, you're not required to super bunch, but you do have the opportunity to super bunch when using the donor advised fund. And then if we focus on the second part of the transaction right here, this part of the transaction allows you to dole out, as I call it, the money to the individual ultimate recipient charities over time. All right, now there are two things to be aware of when it comes to donor advised funds. Number one, once you give the money to the donor advised fund, it is no longer your money, okay? You cannot take it back from the donor advised fund. Once you put it in the donor advised fund, it's just like as if you gave it to the individual charities right at that moment. Okay, so do not mistakenly donate all of your money to the donor advised fund and think, I can just change my mind later. No. We don't want to do that. Only contribute an amount that you are 100% sure you're planning to ultimately donate to the final recipient charities. Okay, number 2, technically the donor advised fund, i.e. like Fidelity or Vanguard, is in control of the money and ultimately could have the final say in what charities actually receive the donations. You are just an advisor to where the money ultimately goes. That's why it's called a donor advised fund. However, I've never heard of this becoming a problem. In every case I've seen, the donor advised fund will just donate the money to where you advise. So this is just kind of a technicality to be aware of. I've never heard of it being an issue. All right, so a donor advised fund is basically like a holding account, although remember, the money is no longer yours once it goes into the holding account, where money sits and can grow through investment tax-free until you dole it out to the final recipient charitable organizations. Now let's take a look at a screenshot from Fidelity Charitable, and as always, I'm just using Fidelity as an example here. I'm not recommending Fidelity Charitable as the best or only option for opening a donor advised fund. All of the major brokerage houses will have essentially equivalent donor advised fund offerings, is what we're about to go over. All right, so it says here, when you contribute cash, securities, or other assets to a donor advised fund at a public charity like Fidelity Charitable. So that language right there, that's why it's no longer your money once you put it into the donor advised fund, because Fidelity Charitable is a public charity. You are giving the money to charity at the moment you put it in the donor advised fund. It's just that these types of public public charities that run the donor-advised funds have the ability to accept the donations and then hold them and dole them out to where you designate over time. And that's why it says right here, you are generally eligible to take an immediate tax deduction. You can take the immediate tax deduction because at the moment you put it in the donor-advised fund, you have donated it to charity. It is no longer your money. Okay, then it says those funds can be invested for tax-free growth. We know about that. And right here, you can recommend grants to any eligible IRS qualified public charity. So again, this language right here, you can recommend grants, which means technically you are an advisor to where the money ultimately goes. But from a true technical perspective, the final decision would actually belong to Fidelity Charitable. Again, I've never heard of that becoming an issue, but that's what this language means when you see something like this on the websites for these donor-advised funds. All right, so the first step again is that after you establish the giving account and then you donate cash or stocks or other assets, you can get the immediate tax deduction, and this is where the opportunity for super bunching comes into play. For example, you could donate like 5 years worth of tithing and take the full tax deduction for 5 years worth all in one tax year, but then you can dole it out to the church or other religious institution over 5 years. Okay, the donor-advised fund kind of allows like the bunching strategy, but on steroids, so to speak. And then, of course, down here, this is where we grant the money to support charities that you love now or over time. This is the key to the donor-advised fund that fixes the problem with the bunching strategy. This allows you to bunch without having to skip years or skip periods of time to do the actual donations to the final charities. And again, you advise us on granting the money to your favorite charities, but they just generally will give the money to wherever you indicate. Okay, so for those of you following along in the Roth IRA conversion video series on YouTube, which can be found, by the way, by simply searching YouTube for Number Crunch Nerds Roth IRA conversion. Let's go over how contributions to a donor-advised fund can be incorporated into our personal tax planning template. All right, so we're in the personal tax planning template. We're in the standard and itemized deductions section. So if you recall from last time, we had bunched $40,000 in 2025, and then we had said, well, we'll just continue with $20,000 every other year as part of the bunching strategy. We also said maybe this could just be zero if you were in a situation where you just shifted this $20,000 over here, or you may have been in a position where you said, all right, I'm going to do a $40,000 bunch here, and then I'll just bunch $20,000 from then on. Now, when it comes to a donor-advised fund, we have the opportunity to super bunch, as I like to call it. So what we could do, for example, is let's say that instead of bunching $20,000 every other year, in our original example, this was $20,000. We're just going to bunch all $100,000 in the same year with a contribution to a donor-advised fund. So let me change these numbers. Okay, so now I have a $100,000 contribution to a donor-advised fund in 2025, and then I have zero of contribution thereafter. Now, if you think all the way back to our original examples, we were donating about $10,000 a year to charity, and we were doing the $10,000 every year. Then we started the bunching strategy by doing $20,000 every other year. Now we have arrived at a super bunching strategy where we have essentially bunched 10 years worth of donations into a single year. Now, by doing that, let's go down to our tax calculation and see where we are. So at the moment, our marginal rate is still 24%. We have no income getting bumped up into the 32% bracket. We have room in the 24% bracket still between $334,650, our taxable ordinary income, and this $395,417, the top of the 24% bracket. But if you recall, if I scroll all the way back up here, we had dropped a $225,000 Roth IRA conversion into that year. here. Now let's take that number out completely and just see what happens for a moment. So I'm going to go back over here. I'm just going to say that this is 0 just to see what happens in the personal tax planning template. All right, so now my income has dropped. Let's go back down to here. So you can see now we're completely out of the 24% bracket with that $100,000 charitable bunch that was contributed to the donor advised fund. In fact, you can see right here we have hardly any tax in the 22% bracket either. We're almost down to a 12% marginal rate. Now the goal is not necessarily to get down to a 12% marginal rate. Remember, we want to fill up our lower brackets in most cases, including the 22 and 24% bracket, depending on what our RMD income is going to be after age 73 and so on. But the point of demonstrating this by taking out that Roth IRA conversion and showing the impact of that additional super bunch is to show that the super bunch strategy through the donor advised fund can potentially open up opportunities for a lot of other tax planning strategies to be implemented in conjunction with this strategy in the same year. Because we now have a ton of room right here in both the 22% and the 24% brackets. In fact, let's just see how much Roth conversion we could potentially do and still not get bumped higher than the 24% bracket. So I'm going to go back to the Roth conversion tax strategy tab. I'm going to start by just putting the 225 that we had earlier back in here. Let's go back to the personal tax planning template and check how much room we have. So we have $334,650 of the taxable ordinary income again versus $395,417 top of the bracket. So we have about another $60,000 of room. And that makes sense because originally we had $40,000 in here. We added another $60,000. So we should be able to do about another $60,000 of Roth IRA conversion and hit the top of that bracket. So let's try that. I'm going to go back over here. I'm going to add 60,000 to this. So we'll make that 285 instead. And then we're going to go back over here and let's see where we're at. So I have 394 of the taxable ordinary income. We're at 395 right there, top of the bracket. So we have basically maxed this out. So the big takeaway that you should have right here is the more that we can bunch, the more that we can squeeze deductions all into the same year, the more it opens up other opportunities for us to employ various other tax planning strategies in conjunction with what we're doing related to charitable contributions. Now, what about this question right here? Can you contribute to a donor-advised fund directly from your traditional IRA? In other words, if I go back over here to the Roth conversion tax strategy tab, should we have a column that reduces the balance of the IRA by the amount that we contributed to the donor advised fund? And the answer to that is no. You cannot contribute directly to a donor advised fund from a traditional IRA. What about a QCD? Can a QCD go directly to a donor advised fund? And the answer is no. You cannot contribute directly to a donor advised fund from a traditional IRA. We will talk more about the QCD strategy coming up in the next video of this series, but I thought I would just quickly mention it right here since we're talking about donor advised funds. Contributions to donor-advised funds need to come from cash or appreciated securities or other assets that are not held within a traditional IRA. Next, let's go over some non-tax benefits of using the donor-advised fund for your charitable giving needs. And one of the biggest ones is going to be right here: simplify record keeping and organization. You don't have to keep track of every gift acknowledgement from every charity you support, just the receipts from your donor-advised fund contributions. So if you super bunch, as we just went over, you could, as an example, have like one receipt to keep track of every 5 years or every 10 years, as opposed to dozens and dozens and dozens of receipts that you may have to keep track of if you are contributing directly to the individual charities. And then one more thing just to be aware of and to check out before you open a donor-advised fund, make sure to check out fees. It says here total fees for a giving account typically amount to about 1% of the balance. So just something to be aware of before moving forward with your donor advised fund strategy. So that's going to be it for video 3 of this series. In video 4, we will start talking about the QCD strategy for charitable giving. And if you are interested in many more examples of how to utilize the personal tax planning template to minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook, make sure to check out my Roth IRA conversion video series on YouTube.